Hey, it's Adam Haney here with the Adam Haney Home Loan Team and Emory Financial. And I just want to talk briefly about loan level price adjustments or LLPAs because there's been a lot of talk about this lately and frankly a lot of confusion because as of May 1st, Fannie Mae has implemented a new set of loan level price adjustments. So first of all, let's talk about who this affects. Does it affect all loans? No, it does not affect jumbo loans. It does not affect VA loans. It does not affect FHA loans, but it does affect Fannie Mae conventional loans. And Fannie Mae is the largest purchaser of loans, so it will certainly affect a large segment of the home buying population. So that said, let's just take a look at what LLPAs are. And essentially, all they are is a risk assessment of borrowers' ability to repay. And it's based on what their credit scores are and how much of a down payment that they're making. And so just like any form of risk assessment, you would take borrowers that have, in this case, higher credit scores and maybe a larger down payment, and you would assume that that is going to be less of a risk. And consequently, under normal circumstances, you wouldn't assess a risk premium because they are less risky. And so what this chart shows us, this comparison between the new and the old LLPAs, is that the areas that are reddish or reddish orange with a minus sign in front of the numbers indicate the areas of the pricing grid that have increased in cost. And what we see is that for credit scores from the roughly 680 to 780 range and down payments ranging from roughly 10% to 25%, by and large, the cost to obtain a mortgage have increased. Conversely, for borrowers with credit scores below 680, where the shaded colors are green or greenish yellow, we see that the costs have decreased. So essentially what's happened here is a large cluster of the home buying population is this area that is in this FICO range, credit score range of 680 to 780 and 10% to 25% down. Those people are having to basically subsidize buyers with lower credit scores. And this was Fannie Mae's idea in order to try to make mortgages, home buying a little bit more affordable for people who have had historically more challenged credit. And that begs the question, is it fair? And if you're asking me, and I'm giving my honest opinion, I would say no, it's not, because as we look at any form of risk assessment, whether you're talking about auto insurance or homeowners insurance, or in this case, a form of mortgage insurance in the form of loan level price adjustments, those who are less risky ought to pay less of a premium. So for instance, somebody has 5 speeding tickets versus somebody who has no traffic violations. It would just make sense that the person with more speeding tickets is probably going to have to pay higher auto insurance. And here, however, what Fannie Mae is doing is, again, trying to make it more affordable for borrowers with have a higher barrier to entry, I guess, let's put it that way, because of their lower credit scores, and making it a little bit more costly for borrowers who have been perhaps more diligent in guarding their credit and paying bills on time. Doesn't sound fair, but that's the way it is. And so, in some cases, maybe it's only 1/8 of a percent more expensive, and we're talking about percent of cost, okay, not an interest rate. So in other words, it's not 1/8 of a percent higher interest rate, it's just 1/8 of a percent higher cost. So for instance, on a $100,000 loan, 1/8 of a percent is $1,250. But it adds up because in some of these, as you'll see, the costs increase by 0.75% or 3/4 of a point. So if we're talking about a $600,000 loan, well, that loan just increased in cost by $4,500. So it's not insignificant. But that's what is happening here, and those are the changes that are going into effect as of May 1st. Now, some of the confusion stems from people think like, well, oh my goodness, should I then hurry up and try to destroy my credit so I can get a better rate? The answer is an emphatic no, don't do that, because people who have lower credit scores are still not going to get as good of a deal as people who have better credit scores. So this other chart shows that no matter what loan to value range, as you go from lower to higher credit scores, there is less and less cost as the credit score improves. So it's just that relative to what the cost used to be, the cost has gotten more expensive for those with better credit scores, and it's gotten less expensive for those with worse credit scores. So the other thing to note is if you have been in the market to buy and you've been, getting quoted for rates for the last 4 to 6 weeks, this is not going to all of a sudden change your price quotes as of May 1st, because lenders have already built this into their pricing, into their rate sheets, probably 2 months ago, because when the loan gets delivered to Fannie Mae as of May 1st, it already has to be baked into the cake, so to speak. So even though the change is happening as of May 1st, the quotes that people have been receiving quotes with this new loan level price adjustment structure for a couple of months at least. So hopefully that helps. But if you have specific questions on your scenario, feel free to reach out to me. We'll go over that with you and any other questions. Hope that helps. Thanks.